Welcome to episode 49 of Accessible Finance, where we demystify personal financial topics and answer your questions you leave saying, I get it now. I'm Eric Johns.
And I'm Rachel Johns.
Let's dive in.
All right. So, Eric, we got a listener email
Okay.
with some situational details and kind of a few general questions about their situation.
Fantastic.
So, I'm going to start by kind of going through what their questions were so that as I give you their details, you can kind of listen through that lens.
Correct. Real quick,
Yes.
we're providing education and generalized hypothetical advice. This is not, don't take this one to the bank, guys.
Correct.
This
Again,
is not considered financial advice. We do not provide advice on this show.
well done. In addition to, there are sometimes details, further details that you might need that would help affect the decision that we don't have based upon the information that was provided to us. I did reach out and ask for some clarification about some of the information they provided so that we had enough information to really work with.
All right.
But
Let's go.
okay, so the questions. Should I convert more of our 401k to a Roth IRA
Okay.
to minimize RMDs and future tax liabilities?
Okay.
How can I optimize the withdrawals from taxable accounts versus tax advantaged accounts?
Got it.
And then what strategies should I be using to reduce the tax impact of my estate on my heirs?
Okay. Very tax focused. Love it. I'm excited.
Right up your alley.
go.
Yeah. Okay. So it is a couple. The ages are 68 and 66.
Okay.
They currently have 36,000 in their checking account, and they have 250,000 in a money market account.
Got it.
Okay.
Brokerage. Okay.
Correct. They also have 6 million in a 401k that's spread across equities, bonds, and REITs.
Okay.
1.2 million in a Roth IRA that's invested in growth stocks.
Okay.
And then they have an additional 600,000 in a taxable brokerage account that's focused on dividend paying stocks and muni bonds.
All right.
They currently spend about 300,000 annually, and they want to maintain that lifestyle while focusing on tax efficiency in their retirement.
Okay.
They have 2 houses. Their primary residence is 2.5 million,
Jeez.
mortgage free.
Okay.
They have a vacation home that's worth 1.5 million, and it does currently have a $450,000 mortgage.
Okay. What's the rate?
6%.
Okay.
They also say they have about 2.5 million in other assets like arts, collectibles, things like that.
Got it.
All right. Thoughts?
Hit me with the questions again.
Okay. So the first question was, should I convert more of my 401k to a Roth IRA? Again, the 401k had 6 million.
Yep.
Their Roth currently is 1.2. So should I convert more of my 401k to a Roth IRA to minimize RMDs and future tax liabilities?
Probably. What is their income?
Well, so they didn't specify. I got the feeling that they weren't W-2'd. So
Are they still employed?
the one of the spouses is. The
Okay.
68-year-old is.
Okay.
The 66-year-old, the wife, is not employed.
Got it.
Yeah.
So the general answer to the question is yes. We almost certainly want to get some additional dollars from this $6 million deferred balance to a Roth IRA. The question on how much depends on a couple of factors.
Mm-hmm.
We assume that if they're not on Medicare now, they'll probably on Medicare by the time their IRMA brackets would matter, or at least the tax return would matter, which would mean that the conversions that we do now will impact their IRMA brackets.
Mm-hmm.
So we're going to think about that. I know some people do not, and they blow through them. We think about IRMA brackets.
And I think part of the reason that IRMA brackets matter so much, and we've talked about this before, is that we accept the reality that we're paying taxes annually.
Yep.
The thought of having to write an additional monthly check to the government, regardless of the amount, feels bad.
Yeah.
It just psychologically, I think there's something that just feels more irritating about it.
Mm-hmm.
So it definitely matters to many people.
Right. So there's some thought they're going to need a decent amount of their RMD for cash flow. Like we don't know their social security information or whether they've claimed,
Correct.
right? Like we assume that I guess the 68-year-old hasn't claimed. I mean, that's a bold assumption. Either
Well, I
could
think
have
that we
claimed.
could say, well, and that's the thing. Again, this goes back to the fact that, when we have people writing stuff in, sometimes like this information that I did get, I got through a few follow-ups asking some additional information.
Mhm.
Um, if you get down to the super nitty gritty, like
Yeah, you're right, right, right.
right.
But
So
to
it
answer the
may be
questions,
a if
right?
this, then if,
Yeah,
but if not,
we could probably things that we can say reasonably, right?
right.
Like if we're taking RMDs from your $6 million, first the $6 million is very likely to appreciate in
Mhm.
value before you take your RMDs. Presumably they're 68 and 66. Their
Yeah.
RMDs will start at 73. So there's
Got
5
another
years of growth
5 year. Yeah.
for the husband, or well for the older individual. It's
It
like
was the husband here.
okay.
Yeah. Mhm.
Then so we've got 5 years of appreciation of the 6 million, and then we're going to start with RMDs. We're looking at RMDs of north of $250,000, right?
So they're
So
almost at what they want to spend annually right there from the RMD.
right. So if they actually want to spend that and they needed all that money, then our conversion conversation would look a little different. But there's
Mhm.
almost certainly going to be some room here for conversions,
Yeah.
even if it's just to the top of the 20. Maybe they're in the 24 percent tax bracket, and that's going to become the 28. Well, we still want to push that forward. We still want to push the tax payment
Mhm.
forward so that we make that 4% arbitrage. And what I mean by that is, if you're in the 24% tax bracket today, we've talked about this before, when the Tax Cuts and Jobs Act ends or sunsets, as they say, at the end of 2025, January 1, 2026, 24% tax bracket is slated to become the 28% tax bracket. So if you changed nothing, you would still gain that 4% by pushing your taxes forward to 2024 and 2025, as
Correct.
opposed to waiting and letting it happen in 2026.
Yeah. And so I think that the first question that was asked was like the should I convert more of the 401k to a Roth IRA?
Mhm.
I think that
Yes.
it's a very informed question. I think the answer we can say is pretty
Yes, you
squarely a
should.
yes. But then the conversation about how do you interpret like what that amount is very situational, very specific, and would be best done with
Correct.
a someone who can
Correct.
provide specific
The
financial
back
advice
of the
to you.
envelope says yes. You're gonna have to go a little further.
Correct. Correct.
Okay. What's the
The
next
second
question?
question was how can I optimize my withdrawals from taxable accounts versus tax advantaged accounts?
Okay. It depends.
Well, and I think that's fair. I think that it may be less about like this specific situation, but like what types of things should we be thinking about when we're trying to determine am I withdrawing from my taxable account? Am I withdrawing from my tax advantaged account? Am I doing 50/50? Like how can I figure out or what's a good process to use to figure out where you should be withdrawing from those like three buckets essentially that you have?
Right. So mostly it's going to be you're going to want to do an analysis of your effective tax rate over time. And for those of you that listen regularly, you're going to hear this a lot, right? Like
Mhm.
you have heard this a lot and you will. So your effective tax rate is going to include things like credits that you're going to get or not get, or
Yeah.
and your IRMA bracket. We include IRMA brackets in our calculation of effective tax rate. So what we're talking about is the total taxes that you pay over your total taxable income. Does that make sense?
Mhm. And I think that that's a really
So it's your total tax liability divided by your
correct.
total taxable income.
I think it's a tough thing to process because I think, as the person paying taxes, it feels really terrible to pay taxes at any point that you're paying them, whether it's now, whether it's later. And so it's really hard to get into the mindset or the thought process of like, it's a good thing to pay more taxes now because I'm going to pay less over my lifetime. Um, and so understanding the effective tax like rate that you have and how it's calculated and all of those pieces if you're not someone who likes spreadsheets like we do, and you're not somebody who likes to live in the weeds, it's probably not your happy place.
Right.
Hopefully, you are working with somebody who can kind of help
Right.
make that tangible.
A simplified way to think about it is we can think about the marginal tax rates. So marginal tax brackets,
Right.
right? Like 22 versus, 37 down the line, something like that.
Correct.
You can think about it that way. Just know that there are caveats that are going to change your effective tax rate, right? Like your IRMA brackets and
Correct.
your credits and whether or not you're going to qualify for like the child tax credit, things like that,
Correct.
by pushing forward your or increasing your modified adjusted gross income through
Exactly.
conversions.
And so it requires like the analysis of tax returns currently, and it requires making some informed assumptions projected forward as far as like what is your income stream going to
Right.
do? What might your tax return look like?
Right.
Um,
So we're starting with your effective tax rate, and you're like, okay, great, that's wonderful. I found out my effective tax rate today
now
is
what?
20. Now what do I do with that number? You're looking at that number compared to future numbers based on what you think might happen. And look, there are a lot of variables. There are a lot of levers to pull. One of the big ones is inflation rate.
Yeah,
How is the IRS going to adjust the inflation rates over time? Or how are they going to adjust the brackets based on the inflation rates? Right? Your
correct.
Social Security earnings will likely be indexed to the inflation rates, right? So then you have the rate of return on each individual account.
Yeah,
Specifically, we don't really, it's not that we don't care. We actually really care about what happens in a Roth account, but it's not going to impact
D-
our effective tax
correct.
rate because remember, Roth accounts, we paid tax already. Now they just get to grow and
That's
we enjoy that.
outside the realm of Uncle Sam.
Right.
You already did that.
Exactly. So we're
Um,
not thinking about
yeah,
that.
we're
So
just looking at
we
there.
do need to know though how much we think this $6 million in tax deferred is going to grow. Because if we
Correct.
choose an 8% rate of return, if we think we're going to make
Yeah,
8% on average per year, that's going to look very different than if we think it's 3 or 4,
correct.
right?
Because they will
That
greatly
compound
impact.
interest, even over the 5 years, is going to be significant.
So I'm going to take a minute to make a brief shout out. I don't do this for you very much, but
Okay.
um, so we actually were
How
working,
excited should I be?
not that excited, but um, so we were actually trying to figure out a way to make this concept really salient and tangible for our clients. And so, as people who we, as people who we really do like spreadsheets a lot. And so, Eric created this document, this spreadsheet that kind of helps project like what has your effective tax rate now, projects it into the future. And then it is very visually appealing. So for people who are not super into, I want to understand how every cell is
Yeah,
interconnected and
just
what
look
the
at the green
formulas
and the
are.
red.
Exactly. And so it's really great to be able to say, like, my effective tax bracket, if I do nothing differently this year, is a lot lower than overall, or it's a lot higher than overall, and it can at least help inform decisions moving forward.
Right.
So even if you don't know the super granularity of it, to be able to have like a grasp on what your current effective tax rate is compared to future ones, I think is important, right?
Sure, absolutely. So then we want to talk about, so we've said effective tax rates. We're going
Mhm.
to look at the differences there.
Yeah.
Why? Why? And the answer is because that we want that number to be minimized over time. So typically what'll happen is it will be low if you're taking a bunch of tax rates, for example, in the present, and you expect to pay tons of tax in the future, maybe your future effective rate might be 30, your current's maybe 20. Okay. That 10% difference there, we want to close that gap. We want to pay more taxes at 20 if the opportunity cost of that, or what we would be doing if we don't do that is paying more at 30.
Yeah.
Does that make sense? So we want to push through that 20,
Right.
maybe push that up to like 23, 24, 25. And then when we're looking in the future, now in the future, we can pay lower taxes.
Correct.
Maybe now we're going to be paying 27 instead of 30, and we're a lot happier with that.
Hmm.
So we're trying to equalize your effective tax rate over time.
Right.
Does that make sense? Is
So
that
then let's
reasonable?
say right now for this situation, right? How can I optimize with my withdrawals with the taxable accounts versus tax advantaged? If like theoretically, let's say that my effective tax rate right now is lower than it will be in the future.
Hmm.
What does that mean as far as where my withdrawal strategy is going to go?
If it's lower today than it is in the
Correct.
future, then we want to increase your effective tax rate today, which would mean generating more taxable income.
Right.
So if we need to we're essentially going to be either pulling straight from the $6 million if we need to live. We would again, we've talked about this 1,000 times. We would have a cash flow conversation first, right? Like
Correct.
they said, they need 300K annually. We need to know exactly what the husband makes. We need to know exactly what
Correct.
the shortfall is and how we're getting that. That needs to be a very granular discussion
Correct.
because we're spending those dollars this year.
Correct. If there's a
So
pension, anything like that, right?
right, right. So we need to know that. We need to know when they're planning on stopping work because that's going to help the future tax rate,
Correct.
effective tax rate estimations. But you said, where are we going to withdraw? We could we can feel more comfortable withdrawing from the tax deferred account because remember, when you withdraw dollars from a tax deferred account, you pay ordinary income taxes on those when you do so, or
Right.
in the tax year that you do so. Does that make sense?
Correct. Correct.
So if we withdraw them in tax year 2024, on our 2024 return, we're going
Right.
to see that number and we're going to pay tax on that number. Okay.
Correct.
So again, we're trying to increase our effective tax rate. So we want to do that. So if we need them to live on, then we pull the tax deferred dollars and then we spend those dollars and we set aside the taxes. We understand what that tax implications are of those withdrawals.
Correct.
We set them aside and then we go and spend the money.
Now,
However, maybe we don't need all that money. Maybe we have enough cash flow from our brokerage or we want to use our brokerage this year. Okay. And we're not interested in spending the dollars Well, then what do we do
Use
now?
your Roth.
We're going to do a Roth
Yeah.
conversion, right? So a Roth conversion is really just a way to pull the income forward, right? To pay
To
the
force the
tax
taxes
now
now. Yeah.
instead of later.
Right.
And then it has a ton of other benefits. Like now we enjoy tax-free growth forever. But
Correct.
like the idea is even if we assume the same returns, the same investments, everything else between a Roth account and a tax deferred account, if they're exactly the same,
Yeah.
right? Then there's no benefit. If we're at 22% tax rate and we assume a 6% return, whatever, we take the same numbers, there's no benefit. So the only reason there's a huge benefit is if there's a disparity in the effective tax rates, the marginal effective tax rates, right? So it's one to
Right.
one unless there's some kind of a disparity, and then we're trying to use the Roth to make it even.
So then, long story short, if the current effective tax rate is lower than the remaining years, right? Lower overall, then you're going to be looking to realize some more gains or
Income
pay
today.
taxes, right?
We're gonna want to pay.
So whether that's pulling from a tax advantage or tax deferred account, converting to a Roth, etc. Now, alternatively, if our friends find themselves in a higher tax bracket now than they would otherwise,
Mhm.
then we're not doing those things.
Correct. We're actually then more interested in pulling from the taxable account,
Correct.
not the tax deferred. We're going to want to pull from our taxable account because remember we have $260,000 in a money market. We're not sure if that's saved, if that's earmarked for another car or a house or a little bit of
Right.
both, or maybe they have reservations. We don't know what
My
that's earmarked for. If
understanding
it's
was
not,
no. Yes.
right. If it's not, then that 250K is going to generate ordinary income. Especially today's money market rates are about
Yeah.
5%, right? So we're going to be generating some income there. And then the rest of the 600K in the brokerage probably going to be generating some sort of tax consequence. Even if we're tax efficiently invested, we're still going to be looking at 1 or so% in dividends there.
Correct.
So point is that we would take from the taxable account because we'll incur less tax consequence from doing so. To the extent that there's no capital gains, you incur no tax consequence, right? If you're just withdrawing basis, you're good to go. Um, but anyway, yeah, we want to withdraw from taxable so that we don't inflate our income today.
Right. We have no
We want
interest
to
in
push that to
raising that now.
tomorrow if
Correct.
our tax rate right now is higher than we think it will be in the
Right.
future.
Okay.
And I know how tired do you think everyone is of hearing effective tax rate and marginal effective tax rate?
I don't know. I feel like we might need to do an episode on that alone.
Yeah, I can't imagine people love hearing about it, but it's interesting. It's interesting to me.
It
For whatever
is.
that's worth.
That's always interesting to you. And honestly,
I like this.
it's gotten to the point where it's become really interesting to our 10-year-old. So it makes our dinner
It's
conversations
fun. I love it.
really, our twins care a lot less,
Oh yeah.
but our oldest is definitely all about the numbers. Okay.
So
So
last question. Didn't they have three?
yes,
That
the
was two.
last one was about what kinds of strategies could be used to reduce tax impact of their estate on their heirs.
Okay, so I didn't calculate all of this up,
Well,
right?
so you've
So
got
what are we at?
you've got like 8 million in
Six,
accounts,
seven.
right? You have like
Is
8
it eight
million.
and then four in
Then
property, real property,
yeah, then
with
4 in
the half a
property.
million we're taking out?
Um,
What are we ballparking this? Like 13,
yeah,
somewhere in that range?
right. Because you've got 8, 4 plus like another one-ish
Okay. So there's no imminent concern.
based
Granted,
on
they're
current,
reasonably young, based on current tax law,
right?
which is set to sunset, in which case there would be a little bit of a concern,
Yeah.
right? So right now, what are we talking about? Right now, we're talking about 13 million per spouse.
Well, they also had the 2.5 in like art collectibles, it's like et cetera. So it's
Oh,
probably
okay,
closer
okay,
to
okay.
15.
All right, then yeah, we're
It's really
we're
close to
thinking
15.
about it to be
We're
sure.
butting right up against
Yeah,
it.
they're already they're right now they're in the clear, but that's about to change, right? So
Mhm.
right now there's 13 million of estate tax annual gifting and estate tax exclusion per person. Okay, the equivalent of gift. Not going to go into that. That doesn't matter. That distinction doesn't matter. Sorry. 13 mil a person, ballpark. All right. That's 26. There's two of them.
Correct.
Okay. So they have 26 million of exclusion. And what was the number? I
About
can't
15
remember.
right now.
About 15.
So you're
Okay.
still
We're
you've
still
got
okay.
enough. Yeah.
We're all right. And those numbers are typically adjusted for inflation annually.
Okay, so that's good.
It's good. However, as we said with the marginal tax brackets changing at the end of 2025, so too are the estate tax exclusions. They're set to essentially be cut in half. They're going to revert, which
Back
they're
out
almost
to the
double, so they're going
13.
to revert. So now instead of being 26 per couple, now it's going to be about 13,
Right.
right? Like 6.5 per person or 7 per person, call it 14 maybe.
Even still,
Yeah,
we're now over that.
right. It's going to be about 7 per person. So what will we do? this is tough conversation that estate attorneys will want to participate in and weigh in
Correct.
on, right? Because it depends a lot on your preferences for your estate, how you want to run, how many beneficiaries do you have? Do you even want to leave it to
Mhm.
beneficiaries? Maybe if you want to leave it all to charity, then we're not having much of a conversation. We're saying, hey, look at this tax
Right.
deferred. We're actually, if you want to leave it all to charity, having less of a Roth conversion conversation because you pay taxes, but charity doesn't.
Right.
So if we
You
can
can
push it
put
all
it
down the
straight to
road,
them.
then let them not pay taxes on the
Correct.
things you were already going to give to them anyway. So if you're going to give it all to charity, they don't really want after tax dollars. They're fine with pre tax dollars because they don't have to pay any. They don't have any
Correct.
tax consequence.
Correct.
So we would be giving them less dollars if we actually pay the taxes today and put it in a Roth or
Right.
even a
Now,
taxable
let's
account.
say theoretically, I would say that the majority of people probably, if you
Want to
have
leave it to their kids.
kids, right.
Okay.
Now,
So
again,
if they were concerned
this is
about it,
not
then they're
specified.
probably leaving it to their kids, right?
Correct.
Well, the question does say reduce tax impact on
Heirs.
my heirs. So
Right.
okay,
So
sorry, I went on that little tangent. Didn't need to go there.
I think it's a fair tangent to have though, because I think we've interacted with people who have, inclinations both ways, or it
Right.
may be I want to leave things to my heirs and I want to donate or have part left to charity.
Right.
Um,
So in this case, it makes Roth conversions a little bit more appealing, okay? Because if we don't pay taxes on the money, right, and then we increase the size of our estate will pay 40% tax rate on
yeah,
everything that's over the annual or the lifetime exclusion.
right,
Okay. So if we're paying the taxes right now and putting it in a taxable or a Roth account so that our heirs don't have to, because if we leave a tax deferred account, like if you leave an IRA or a
right.
401k
401k.
to your heirs, right? That's included in your gross estate. So essentially it could potentially be subject to estate tax if you're over these limits. And when your heirs get the accounts and they make withdrawals, it's
They're
included in
paying.
their ordinary income when they withdraw the
So
dollars.
you're like multiple
Right.
tax
So
on
if we
it.
want to get around that and we want to reduce the amount of our estate, what we can do is we can convert some of these tax deferred dollars, right? So that means roll it into a Roth.
Yeah,
And then we're going to pay in taxes. Where are we going to get those taxes from? Well, our pile of wealth. So
right.
our taxable accounts, for example, we will draw down some of the 600K brokerage, 250K in the money markets, call it $1 million in taxable. We pay some of the $1 million, therefore reducing our state tax consequence.
Exactly.
And we're making it so our heirs now don't have to pay tax when they pull the money out. So it's very beneficial in that
Multi-benefit.
way
Yeah, yeah,
to leave money within Roth accounts and to
yeah.
pay
Right.
the taxes on the front end. Even if it's in marginally higher brackets, it
Correct.
changes the calculus quite a bit. This is their
Correct.
concern.
And I think
So it
bottom
makes
line
Roth conversions
too,
much better.
exactly. And then you're looking at some type of potential like gifting during lifetime, things like that, right?
Absolutely correct.
So
Absolutely correct. Lowest hanging fruit, in
yeah,
addition to all of this, annual gifting.
yeah,
What does that mean in 2024? It means you're gifting $18,000
right,
to every person that could potentially be a beneficiary, right? So if you have your kids, you're thinking like maybe I have two kids, okay?
correct,
$36,000, right?
correct,
18 times two. But then you're like, well, wait, that's not really making enough of a dent.
right.
What am I going to do? Well, maybe those kids have kids and you have grandkids.
Maybe they have
You
spouses.
can gift 18K to each of them. You can gift to their spouses. That's right. You could gift to their significant others if you trust them. You know what I mean? Like you can
Right.
gift to whoever you want that positively impacts their
Yeah.
lives
In addition to that, I
and
do
pay no
think that
taxes at
there
all.
is a like qualitative benefit of being able to observe the people that you love and care about enjoy the
Absolutely.
funds during your lifetime.
Great point.
So there's a lot of benefits there. And like Eric said, this is something that would fall very squarely in the estate attorney realm of expertise. But, hopefully you are working with, like, this is a very involved, pretty
Yeah.
complicated
Yeah.
situation. And over the
You probably want a
next,
little more than, our off the
exactly.
cuff
Well,
back
over the
beyond the
next few
non
years, I
advice
mean, you're
spitball.
68, 66, and you're talking large amounts of money, lots of complexities. And then you're right in that pre-retirement zone where
Mm,
the decisions you make over the next few years are
super impactful.
wildly impactful.
Best Roth
Exactly.
conversion years if you're going to do them. Yeah,
So
absolutely.
this is a prime case of somebody who, or a couple who really should be looking at seriously working with a financial planner, a financial professional.
Mhm.
And hopefully that is a financial professional you trust enough to be alongside you when you are meeting with that estate attorney and somebody
Absolutely.
who can basically see through the lens of all of your big picture stuff as you're looking at that specific estate piece.
Yeah.
But yeah.
All right. Well, if you enjoyed today's
Yeah.
episode, please review the show. And if you have any topics you'd like discussed or financial problems you would like solved, reach out to us at podcast@equilibriumfp.com or visit our website, equilibriumfp.com. And go ahead and like the show on YouTube if you're watching there. Appreciate it.
Yeah. Till next time.
Thanks, guys.